Hi, and welcome back to the Divine Stewardship Podcast, episode number 6. I'm Chris Stanton, and I'm with my lovely wife,
Corinne.
And today, we thought we'd talk about whole life insurance and the benefits of whole life insurance.
When I always thought of whole life insurance, it's always been the more expensive policy, the one that costs more money monthly, but also will give you the higher death benefit. However, thinking of that when you're starting a family and you have your children and you want something like in the event, it always felt like term was the way to go. Term was like the lesser of the policy. It lasts for either 10, 15, 20, 30 years. And then you in hopes that you either have to renew it or maybe even not have to renew it, that there's no one relying on your income. But whole life, I never realized was anything more than just a death benefit.
Right, and that obviously coming from the history that we had, the background that we have, especially following the Dave Ramsey program, FPU, that's he rails against whole life. Like you should not ever look at whole life. Buy term and invest the difference. That's the big phrase. And even there are some insurance companies that are like that. Primerica, for example, that's their whole motto. They don't even have a whole life product available. So yeah, there are those differences, and what you said is not necessarily wrong, right? You actually said whole truths. But there are benefits to whole life outside of just simply having that death benefit. There are so many different things that a whole life can provide you, and it's not discussed enough. Like when an insurance agent comes to you and says, "Hey, would you like some whole life?" That's a permanent payment. You're going to get this really good death benefit, but that's when you die.
Right. Someone else will benefit
40, 50, 60, 70 years down the road.
Right. So you're paying into this
for the rest of your life.
For the rest of your life.
For a very large amount of money that you will never see.
Right.
Right? Your beneficiaries may see it.
Right.
Right? So there are these like thoughts like, why would I want that? Why would I want that?
Coming from, obviously we're parents, and when we think about, oh my gosh, what if we were traveling together, and what if it was our time was up and we left our children with, let's say, a mortgage, car payments, car notes, left them with a bunch of debt, a bunch of consumer debt. Right. I don't know. I mean, some of it I'm sure goes away when someone passes, but student loans, that goes away with when you pass, right?
No, it can actually go on to your...
Oh, see, all these things.
So like if you're let's say your parent's still around, okay? And your parent signed on to a Parent Plus loan.
Right.
Okay?
They're on it.
And let's say we have a tragic accident.
They're still
is on them.
responsible for that. That's right.
So, little thing about student loans, little rant there, but a student loan is the only type of debt that isn't washed away with even bankruptcy. So you can't claim bankruptcy and get rid of a student loan debt.
Yeah, I remember people calling in and being like, I have $150,000 of student loans and I only make $50,000 a year. And I want to file bankruptcy so that it gets right and I could start over. And they were like, "Don't do that." On the Dave Ramsey call, so don't do that. No, you can't. You still are responsible for those student loans.
Right.
So now you're just putting yourself in a worse position. That's not the best option for you.
So when you let's say you don't have insurance, it will whatever assets, like they're going to get their money back. Mm-hmm. Okay, the government will get their money back. That's like the first thing. Mm-hmm. Then comes like the mortgage. So it'll go down the line as to whatever debts you owe. That's who will get paid first. Right. Okay. And they're always going to get their money. Like any debtor that you have will always get their money regardless.
Right. Which is why parents like to have life insurance policies. Just in the event something happens, it doesn't fall on their kids, which I understand. Right. But now if I'm coming to you and I'm asking, what makes this whole life policy, this cash value whole life policy better than just parking whatever money I can save into an account that I know is always going to be there, even if it's maybe a little bit of interest. I know it's going to be there. It's liquid. I can take it out when I want.
Right. So okay. So there are a couple of things there. You mentioned cash value. So that's one thing that term life insurance does not have is a
Right.
cash value.
Right. You can't touch
So
it.
now, what is cash value? Cash value in a whole life policy is cash that is now accumulated within your policy in which you can take out. And what I mean by take out, borrow against. Okay, you can borrow against the cash value of your policy, or you can actually withdraw from the policy that cash value, which I wouldn't recommend, because then it messes up with the numbers on the interest. Now, when you said interest, what were you referencing? Were you referencing interest that grows on the account, or interest it costs?
No,
the
no,
account?
I was talking about growth. Like you park it in like a money market, or you park it in like a high yield savings account.
Right.
You're you're limiting yourself to the amount of interest that you can make on your money.
Well,
because it's low.
Well, like high yield savings accounts,
They're not
right,
that high.
Right now, though, they're higher than a regular savings account.
Right,
You're looking
they are,
at maybe somewhere between 4% and 5%. Some
Which is
cases, if you can
pretty
find an online
Right.
say high yield savings account, they're pretty good.
Right.
There are those other accounts that maybe at a traditional bank that'll give you 2-3% high yield savings.
That's what I was thinking more
You
of.
have money market accounts.
They don't give much.
They're not that great. CDs, you could buy CDs.
But that ties up my money because I have to wait now for it to mature.
Right, you have to wait for it to mature.
So that's not a good option.
To get that interest rate, to get that
Right.
interest on it.
Right.
So yeah, there are those types of interest, and this is another thing most people may not know, is that the insurance company, mutually owned insurance companies, because there are stock-owned companies, meaning they're owned by shareholders and not mutually owned by the policy owners. Okay, so there's different types of ownership. Mm-hmm. So I always recommend and only deal with mutually owned, dividend-paying life insurance companies. Mm-hmm. And that does make a difference. There is interest built into those accounts. So you're paying a premium, they're providing a death benefit, but also there's a guaranteed growth of interest on that money that you put in.
Even if I was to take out from it.
Borrow against it.
Borrow against it
from the cash
value.
That is huge. Okay.
Let's go into
and this
that
is another, and this is a great point, because this is where, in my view, it beats a high yield savings account or a savings account in general. Mm-hmm. Because if you find a high yield savings account that is providing you, let's say, an interest rate that's higher than what a whole life insurance policy would give, okay, it can be done. They're out there. The issue is you put money into the account, into the high yield savings account, okay? It grows interest. Any interest that's grown on that account is, number one, it's taxable.
Right.
That's number one. Oh, see, little thing there. It's taxes. No, taxes. Let's see if this works. Oh, you see, no, yes. Taxes, no good. So the interest grown on a whole life insurance policy, not taxable.
That's a
so
perk.
It's
that's a good perk.
Tax-free growth.
That's a good perk.
Another really good perk is the compounding interest. So Einstein said that compound interest is the eighth wonder of the world. Those who know it love it and utilize it, and those who don't know it lose by it. Okay, it's extremely important, because in a savings account, traditional, or any other account, you put money in, you're growing on the principal. The interest is on the principal. Mm-hmm. What happens when you would take that money out?
You're not growing on the principal anymore.
The principal amount, right?
It goes down, so you're making less.
Exactly. Right. The amount of money you take out of the account now affects the amount of interest that can be built on that.
Right.
Whereas now, let's say we switch and we put that money and we run it through a whole life policy first. Mm-hmm. Now, let's say I want to access some of that cash value. I've built up cash value and I want to access some of that money. All right, fine. I borrow against the cash value. Mm-hmm. So I go to the insurance company and I'm like, hey, listen, I'd like to take a loan out.
Right.
Usually at a very good interest rate, much lower than a credit card. much, much lower than a credit card.
Or a personal loan or anything like that.
Anything like that. Any type of banking product, you're going to find this to be at a competitive or better interest rate. Okay. And by doing so, the money that you take out or you borrow out is tax-free, because loans are not considered income and therefore not taxable.
Right.
Same method is done if you take money out of your house. When you do a refinance or you get a HELOC, that loan money is taken from the equity, your house's collateral.
Right.
Okay?
Right.
That money is tax-free.
Right. Okay.
That's a very big method for real estate investors. They'll buy a house, fix it up. A year later goes by, they've built up equity in that house. They'll now borrow from the equity of the house, refinance, take the cash out, and go and purchase another one.
Right.
So, right there, you have the availability of taking the loan against the cash value at tax-free money.
That's huge.
That's big.
Yeah.
But now, what happens to the money that I've kept in there? It's uninterrupted. I didn't touch.
So it continues to build.
Right. I didn't touch my money.
Right.
I used the insurance company's money. So all the money that I parked there continues to grow at an uninterrupted rate, whatever that interest is. It's continuing to grow. I never touched my principal, so it's getting the full maximum interest rate growth.
Right. Not on a lesser principal,
Right.
on a lesser amount.
Right. Not on a lesser amount. So now it continues to grow at that same rate year after year. Now, the rate is guaranteed. So that is a guarantee. It will not change. Banks, what about banks? They're tied to interest rates. So the interest rate on a high yield savings account is dependent upon what the Fed says the interest rates are.
Right.
So they can go up, they can go down. Interest rates on a high yield savings account are only good when interest rates in general are high, because then they're going to charge you higher interest for saving.
Right.
But when interest rates are driving low and the Fed has already said that they're going to start lowering interest rates even further, guess what? The interest rates on the savings accounts is going to go down.
Right.
Because all that does is it hurts the saver.
Right.
It's meant to have people start spending more, right? Borrowing money more because the interest rates are lower.
Right.
So your guaranteed rate of growth in a whole life is that guaranteed. It's not going to change regardless of what the Fed says.
Right.
Regardless of what the interest rates are. It's the interest rate that you signed a contract with that insurance company that guarantees me that growth. It's a contract. It's a contract
Right.
with that insurance company. So you get that uninterrupted growth. You get to borrow money at a much better interest rate or competitive interest rate compared to what's out there, much better than a credit card, for sure. So you have that available to you. And here's another thing. So now it's a loan. Loans have to be paid back.
Now, what if before you pay back that loan, you pass away? What happens to the amount of the death benefit?
All right, good question. So any outstanding loans that are on a policy are taken care of first, right? Because the company has to get their money, just like the government's going to get their money, any other debtors. So the insurance company is no different. Let's say you have $2 million in death benefit in your policy, and you have 50,000 or 100,000, let's say 100,000 loan that's outstanding.
Right.
Your loan is collateralized by your death benefit, meaning that it's backed up by the death benefit.
So they just chop it off the death benefit, and then the rest of the death benefit goes to the beneficiaries.
Correct.
Right. So that was big, because that was one of the first questions I had when
So
talking about this.
so let's make even more simple numbers. They'll be large, but it serves a purpose. Let's say you have $1 million policy.
Right.
You have $500,000 outstanding
Right.
loan. Remember, you took out and got debt-free income or debt-free loan.
Right.
I should say tax-free.
Tax-free, yes.
Tax-free. So now you pass away and you still have that outstanding $500,000. The insurance company says, okay, we're going to take off $500,000 from the death benefit and you get the rest.
Right.
So you still walk away with $500,000.
Right.
Or I should say your family does. Because
Right.
You ain't doing that much walking.
You're
not doing much walking.
You can't take anything with you.
Exactly.
Yeah.
So, but yes, your loan is collateralized by the death benefit.
Now, what if nothing happens and now I want to pay this back? I have the option to pay it back. I cannot pay it back. It's in my best interest to pay it back. What does that look like as far as, okay, I want to pay this back, but I want to pay it back in an affordable way. I don't want to, it's like, I guess similar to borrowing from a 401k. If you don't pay it back, you suffer in the end, correct?
Right. So here's a big thing, and this is a very, really, really important strategy. All right, it's a strategic thing, and the only reason why I say strategic, it's because it allows for a lot of potential and a lot of different possibilities. So a traditional loan. Let's say you go to the bank. Okay, you got to get a loan. All right. You get the loan. It's X amount of interest. Let's say you owe $400 every month. All right, that's your principal and interest, and the loan has 5 years you have to pay it back. You now are on the hook for, at very least, $400 every single month.
Right, until it's paid.
Okay, until it's paid back.
Yep.
Now, that payment has interest. So the bank is making money
Right.
on every single one of those payments for the whole duration, okay? Now, let's say you do it, that's what we call a scheduled loan or scheduled repayment, okay? Because every month it's scheduled and you are obligated, because that's the contract that you sign, that's the agreement that you have when you get that loan from the bank. Now, let's flip it over to a whole life savings account.
Okay, so now I've taken a portion of the cash value against my policy.
And you've done all the numbers, and you say, okay, $400 is going to be my payment. If I do okay.
Okay.
Now, you don't have to pay it back on any particular schedule. It is an unscheduled repayment plan. Unscheduled. So, at the very, very least, whenever you're at the end of the year, whenever that policy loan anniversary date is, at the very least, you should always pay at least the interest that's accrued on the outstanding. Okay? Because if you don't, remember the compound interest, now it's working against you.
Okay.
And now it's going to start eating into the cash value.
Okay.
Notice that I didn't say you had to pay back the loan. Had to. As a good steward of thy money, and as a good coach, I would always recommend and tell my clients, always repay your loan. Very clear. Always repay it, including the interest. Okay? Always. But on the scheduling of the repayment,
That's up to you.
that's on you.
Right.
You decide. You're still saving, because there's two different methods, right? There's two pathways there. You're still saving money.
Right.
It's the loan payment.
Right.
Okay, that's extra. So like if you went and bought a car, you're still saving money and you're paying your car off. It's the same concept, same idea. You're financing. But now you've become the financer.
So you become your own bank.
It's essentially what it is.
You don't have to.
It's the banking function. Like it's not like I can't call it a bank because it's not
but
an
you're
institution.
putting the money into your own policy
It's the
rather than
banking
giving
function.
it
Exactly.
to the bank who's making money on your payments and all
now,
your interest.
And I'll also be clear to say this, like they'll say you're repaying yourself back plus interest. Yeah, yes and no. The interest isn't going to you. It's going to the insurance company. But because the insurance companies are dividend paying out, again, find an insurance company. We only deal with insurance companies that pay out dividends. What is a dividend? A dividend is additional monies that is that you are the recipient of the company's doing better, right? So,
right.
if the company does well,
It comes to you.
they give out their profits to
Right.
their policyholders
Right.
in the form of dividends,
Right.
right? So, your interest paid on that particular loan goes back to the general account for the insurance company. The insurance company shows a positive for the year based upon their investing on the money, based upon the interest that's accrued and paid on all outstanding loans. And they take all that money, and then what they do is they give it back to the policyholders in the form of dividends. So are you directly getting the interest back into your account? No, it's not a direct growth of interest, but it comes back in the form of a dividend because the whole insurance company is doing better.
Right.
And the dividend it's not guaranteed. That's a portion. It's not a guarantee.
Right.
Regardless of whether they're a dividend paying life insurance company, it's not guaranteed. But the companies that we work with have never missed a dividend in any year. And that includes the Great Depression, the Great Recession, like World War I, World War II. Like all these great travesties that happened in world history.
They were still
not only American history, but within world history.
Yeah, and they were still able to give
they
out those
still
dividends.
gave out dividends.
Okay, so there you go.
Like it's, and another thing I'd like to say is, what about the companies themselves? Like, what's so important about the company? Well, the reason why I keep on mentioning the company or the company that you work with, you want to work with a company that's been around for a long time, right? You would say, like, this company's got experience. They know what they're doing. They've been around the block once or twice. Well, companies that we work with are 100 years or older. They've been around for a century. Imagine that. You've been around a century or more, and you've never missed out paying a dividend to any of your policyholders.
Yeah.
Mutually owned policyholders. That's huge. Absolutely huge.
Yeah. So what if now we're working with the clients that already have their existing plans? Are there plans that someone may already have that can be transferred into one of these cash value whole life, or even a term life insurance that can be, I guess, used? Whatever they've, I guess, how do you,
those are good
whatever
questions.
They have in their cash value,
so
can it be used?
So cash value is not accrued in term.
Okay.
So term, if you have a term policy, you just have to stop paying on a term policy and start paying on a whole life.
Right. So the money you put there, you could potentially put into one of these.
Correct. So you would just stop on the term, and then you would move on to the whole life.
Right.
Now, if you already have a whole life policy, and you have accumulated cash value, and you want to come on to one of our specially designed whole life policies that increase your cash value, yes, there is a method in converting that one to the other. It's called a 1035 exchange. And you can take the cash value out of that one policy and transfer it into another policy. So therefore, you don't lose that portion.
Right.
Now,
what you've already put in.
Most of the time, policies that are traditionally designed, you will have paid quite a lot of money into that policy. Okay.
Okay.
But your cash value is not accumulated.
Right.
It's always better to recapture whatever is available to you and take out. Like it's good to do that.
Yeah.
The way we design it is that cash value is put at the forefront. So it's at the expense of the death benefit. So the death benefit won't necessarily be as high. But what we'd like to do is, as the cash value grows, so does the death benefit.
Right.
And the death benefit will always be higher than the cash value. So the idea that you lose your cash value or all the money you put in is false, because as you continue to put in, remember your cash value is growing on interest. It's growing. The amount that you put in stays the same, can stay the same, or decrease in the cases that we design them. Can decrease over time, depending on how it's designed. So we can have that in there.
Right.
We can even design it to where you stop paying.
Right, at a certain point.
And it continues to grow.
Right.
Why? Because again, you've gotten to that point where now your interest is building on that cash value every single year. So what I'm trying to say is you can pay into it a certain amount, and your cash value will be higher, can be higher and grow higher than what you're putting in. And your death benefit will grow along with it, and it will never outpace or be lower. I should say it will never be lower. Your cash value will never outpace your death benefit. Your death benefit will always outpace your cash value. So essentially, in the long run, the amount that you put in will never be equal. It'll always be less than what you can potentially get out or what your family can get out of it.
Right, which is great.
The fact that people think that you'll never get what you put in, no, that's not in the long run. As long as you stay and we're in this for the long term. You're not in the short term. The money that your family receives will always outpace what you've put in. Always.
Right.
It's just there. Even if you were to take money out, let's say you're retiring. Let's put it this way. Look, let's say you're 80 years old. Okay? You got a family. You still got some spunk. All right? You want to go and live a little bit, right?
I know.
You want to go live a little bit more, 80 years old, all right? You want to go travel the world at 80 years old.
Okay, that sounds good.
All right? YOLO. YOLO.
And YOLO and FOMO. I don't want to miss out.
So YOLO, right?
YOLO.
What are we going to do? I got a whole life policy, right, that I've specially designed, or I had specially designed for me. And I look at it, and it says, I've got $500,000 of cash value.
No one relies on my income anymore.
Nope.
I now have no debt because I've used this to help me pay off my home and all the things. Well, I can definitely start using that while I'm alive and
100%.
still able to.
That's it. I'm going to go take out $300,000.
Ooh, that sounds like a nice trip.
And guess what? I have a death benefit. That's $3 million. $2 million.
That's nothing.
I don't ever have to pay that back.
Right. And
as
my
long as
family
I stay
will
on
still...
the interest, as long as I stay on the interest,
Right.
and
my
I can
family
probably
will
cover that
still-
with Social Security,
Yeah.
or whatever. That loan, that $300,000, don't ever have to pay tax on it. No income tax, nothing. The remaining cash value continues to grow. I've stopped paying into the policy 5 years ago, whatever.
Right.
Death benefit, and then let's say I die 5 years later and I had still that outstanding $300,000, but I was good enough to pay the interest, so all that's left is just the $300,000 outstanding. My death benefit has grown. All right, so it went from $2 million to maybe $2.5 million.
I think the family will be able to cover end of life
They'll get
costs.
$2 million plus.
Right. So I think they'll be able to cover the expenses that they have to cover for my death.
And at that point, we start talking about, again, thinking long term. You're looking at legacy, right? So like your family is getting that money. Where is that money going? To whom is it going?
Right.
What rules have you put in place so that the money isn't squandered or wasted?
That's a great perk.
That's something that we can talk
To be
about,
able to,
to talk about at a later podcast. But these are just some of the benefits, right, of what a whole life, especially designed whole life policy, can do for you. Now, can a poorly designed or a traditional designed whole life do all of these things? Absolutely. They can. But that cash value, it's not going to grow as much in a traditional.
Right.
You don't have access to it immediately, okay? Because on a traditional whole life, you may not see any cash value accumulation until like
years.
what, year 7, 8, 9, 10,
And it's small.
and it's a small amount. In the way we design them, you're breaking even, and what we mean by breaking even is where the amount of money that you're putting in equals your cash value or more is probably anywhere between 3 to 5 years. And why do I say that? Well, we got to remember, it's not like a traditional savings account. It is an insurance. You're getting a death benefit, so there is the cost of insurance.
Right.
There's the the compensation portion of it for the agent. There's all these things. So it's not like a one-to-one right away. There is some negative on the cash value for the first couple of years. 100%. But again, we're thinking long term. We're looking down the road. And if I can have the money that I'm putting in at the same or better in 3 to 4 years, and then from that point on, I continue to put in and I'm making more than what I'm putting in, it makes sense.
Of course.
And then you get your death benefit.
And how soon can that death benefit be taken out to be used? Not the death benefit, the cash value.
So once the cash is in the account, it could be taken out and used within 30 days. Up to 90% of the cash value within 30 days.
So this is like you front load the
if you were
policy.
to front load it.
Right,
like,
right.
even if I put if I did month to month, let's say, if I put $1,000 the next month, within that month, 30 days or so, I can access that 90% of whatever the cash value. I can take up to 90%.
Right.
So there is that, but again, it's a savings. We don't necessarily want you to do that on this. We want you to use this as a long-term savings so that you start building up on that cash value. Real estate investors really like this. They can take money on profits and they can put it into the account. Because here's another thing, another perk. Because it's a private contract between you and the insurance company. It doesn't show up on credit reports, or income to debt ratios. So if you're a real estate investor and you want to get money to go purchase another property, and you go to the bank and the bank's like, you got too much outstanding debt. We're going to need more collateral.
Right.
Like, you got to come up with another $500,000 to get the money so you can go buy another one. If they take the money and they park it in a whole life insurance policy, they don't have to worry about a debt to income ratio, because guess what? The insurance company doesn't care. They don't care. You have a collateral on your death benefit.
Right.
So you have access to 90% of that money right away within 30 days. Like, that's liquid. You can take some of that money and go and purchase that other property. No questions asked. And guess what? The repayment on that loan doesn't have to happen right away. So like, if I went to the bank, I'd have to start paying
right away.
the right away at a certain amount.
Right. You can at least wait till that income property
It's
starts
starting to pay you back.
It just makes sense for especially that. Yeah.
You just got it's amazing. You saw that right away.
Yeah.
I don't have to pay it back right
Right.
away. I can let the property breathe essentially, right? Before I can wait for it to start producing that income, where then I'm just now paying back the loan at the time the property starts to produce it, instead of having to dip into maybe some savings in order to cover that payment until the property started making money.
Which is just great. Yeah.
It's perfect. It's perfect. It gives options. That's the point. It's options. And not only this, I'm going to mention this one more time, or I should say another benefit, is the living benefits or long-term care riders that can be added onto the whole life policies. So with certain companies, they have these called living benefits. Now, living benefits are additional perks added on to certain whole life policies that, in the event, let's say you get a chronic disease, okay, or you become disabled in certain ways, okay, you can get what they call an advancement on your death benefit, like up to 80%, let's say, of whatever your death benefit is, right up front. Now, let's say you have cancer, okay, and you need money for the treatments, and you don't have it in your regular savings.
Right.
and you have one of these living benefit riders on your whole life insurance, you can access 80% of your death benefit as an advance in order to pay for those treatments.
So instead of your spouse or your family worrying about the financial aspect, they can be fully supportive in the treatment and what we need to do.
Everything. You have the money. You have the money.
That takes off a lot.
A lot of stress.
A big weight on the family.
And guess what?
Spouse.
Think about stress. Stress, they say, is a killer. Stress is a killer.
Yeah.
Imagine not having to worry about that.
Right.
Where you can only focus on recovery, only focus on the treatments.
Right.
Not having to worry about the finances. I mean, it's a beautiful thing. It's another added benefit.
Right.
And then long-term care. Again, you go into a long-term care facility, right? Who's going to pay for that?
A fortune.
They cost a lot of money.
They cost a fortune.
You can have that added on to a life insurance policy where, again, you're afforded a certain front money from the death benefit to pay for the long-term care, which, again, is taking away stress from the family members and from any other additional finances that you may don't have to tap into.
Right.
And again, this isn't a replacement for investing, right?
No.
The whole life insurance is not an investment. This is a savings vehicle that has very good benefits, living benefits that you can utilize it for other things. It is not an investment. Investing is putting money into like the stock market and into mutual funds and maybe real estate investing. That's investing.
Right.
This is not a replacement for that. This is more of a foundation thing to allow you to go and do more things.
Right.
Because you have this really bond alternative on steroids. Really, that's what it is.
Yeah.
So like if, let's say, a person is an investor in the markets, in the stock market. Instead of designing your portfolio to include bonds, take that portion and put it into a whole life policy. So now your portfolio can be really, really good for all mutual funds, personal stocks, all of that, because you've got your bond alternative savings on steroids in your whole life. I mean,
Yeah. I mean, if you're saving money every month in just a regular account, which you should be, it's just, there's so many more benefits.
First.
Run it through the policy, because then the benefits that you receive are so much more than just putting it in one of those accounts.
You get uninterrupted growth.
Right.
You can borrow against the policy.
You're not dependent on
pay
interest
it back
rates.
when you can. You're not
down and up and down.
Exactly. Stock market going up and down.
Right,
Who cares?
right.
It's not affecting it doesn't affect your policy at all.
Yeah.
Doesn't affect the growth on the policy at all.
Yeah.
Not at all. So these are just some of the benefits. I think some of the major ones.
But those are a lot of the things that I hear over and over again, well, I've always heard about the whole life not being the way to go. It's too expensive and all the things, and someone told me to go with. This answered a lot of questions for me when I had all those questions.
Yeah. And if you'd like to have the same questions and want a little bit more clarity on your particular situation and your plan, by all means, give us a call. We'll schedule a clarity call. We'll answer, all of your questions. And we'll see if it's something that is good for you, because this may not be for everyone, and that's that needs to be said. This is something that you may not be ready for this, because it does take a different mindset. It takes a different type of mindset to grasp this.
Yeah.
I'm not saying it wouldn't be for you in the future,
but it's a free call.
I think everyone could do this. I honestly think this should be for everyone, but not everyone is ready. Does that make sense?
Right.
Not everyone is ready for it. We weren't ready for it right in the beginning.
No.
So you have to learn more. You have to have a coach who can explain this to you, who can guide you through the process. I would recommend starting earlier in one's life, because again, it is life insurance, and the cost of insurance does go up as you age. And
as you age, you have more health issues,
right,
and those affect your premium.
Yep.
So the earlier you can get yourself into a policy, the better. But it's costing you a half an hour of your time to figure out if this is something for you, which I think is worth it.
And if you don't get it within the half hour and it takes a couple of sessions,
we'll go over.
It goes over. It's fine. It's not. This isn't like something that you absolutely need now, although I would highly recommend it for everyone, it takes a different type of mindset to really grasp this. And, not everyone is ready, but if you understand or just at all just curious about this even more, like definitely give us a call, reach out, and we'll walk you through the process for sure. And we'll design it towards your needs. And again, it doesn't, as I said, I forgot. We'll go again, but it doesn't have to just be on your spouse or on yourself.
Right. It could be on.
What about your kids?
Yeah.
What about your kids? What if you start a policy when they're like 1 or when they're just born? And you start feeding that like you would, let's say, a college savings account, a 529 account, let's just say. Instead of replacing the 529 with one of these, 18 years worth of growth.
Interest growth, yeah. Putting into it. And
Imagine.
then also the death benefit.
They could take some of that money out, maybe use that to finance a car.
Right.
Use that to finance some college.
First home.
Put a down payment on a home.
Right. It's not getting easier for couples to get married and buy a home in the beginning of their marriages. So something like this could be a huge blessing for children as well.
In the future, absolutely.
Yeah.
So, anything else for today? I think we covered a lot. That was a lot.
Yeah. But those are all the things that you think of when you think of this type of policy and the skeptics of, wait, that doesn't sound right. This sounds very salesy. This sounds whatever. Truthfully, you need an agent that sets these things up with the right purpose and for your benefit, not for their own.
Yeah.
And there are agents out there that will set you up with policies because that commission looks nicer in my pocket. That is not what you need. You need a coach that has the heart of a teacher.
I didn't even talk about that.
You need a coach that has a heart of a teacher and that has the right motive in mind, which is the benefit for you and your family, not us and our family. Because ultimately, this is something that we want you to start for your legacy planning, for your kids and your kids' kids. And
Again,
all
long-term thinking.
Long-term thinking. So
that can be beneficial for the short term, but it's mainly for the long term. Yeah. All right, awesome. Well, we'll end it there. I think we'll start maybe another topic, or rather another podcast later in the down the road on why this isn't something that's talked about a lot.
Right. Yeah.
And one of the big reasons is what you said, commission.
Right.
Is a big thing.
Right.
So maybe a little hint of a spoiler. Commissions on these specially designed policies are not high.
Not really. No.
They are not high. They are quite low compared to traditional whole life policies. So
which don't have those benefits. So.
Right. All right. Until next time, we'll catch you on the flip side.
Have a great day.
Bye.